please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Money Money Money, your weekly personal finance date with me, Surabhi Upadhyay. Time flows fast and another year is about to come to an end. 2017 has been a dramatic year when it comes to the way we've dealt with money and investment. From demonetization to RERA, the impact of big policy measures is perhaps still being felt in the economy. So this week on the show, we're covering the very timely released Karvy India Wealth Report, which gives us some interesting anecdotes from all that shaped investment in fiscal year 2017. I have with me Abhijit Bhave, CEO of Karvy Wealth, to tell us a lot more about these interesting findings, but also to give us a sense of what may lie ahead as we think about personal finance and wealth creation, money management in the year 2018. Mr. Bhave, great to have you on the show, and thanks so much for dropping by.
Thank you for inviting me.
And as I'm saying, it's a very well-timed report,
yes,
because, you know, we are in that reflective mode. One is wondering whether these tectonic changes that kind of swept through, you know, demonetization, those big lines to get cash, the move to financial savings, you know, the almost forced move to equity mutual funds.
Yes.
But anyway, let me not take away from, you know, the broad findings. What for you have been some of the biggest things that stood out in the study?
As you rightly said, this has been a year of structural changes, and a lot has happened in the year. And this year what we have seen is this year has also been a year of wealth creation. So because demonetization forced the money to move into banks, we saw a lot of money being invested in financial assets, and they have really boomed. The wealth creation charge has been led by equity. And a lot of money has moved into equity, direct equity and mutual funds. Money moved into current accounts and savings accounts also. And the financial assets went up by as much as 15% in the last financial year. In terms of equity, besides mutual funds, we also saw a lot of money moving into unlisted equity, because this was the year of the IPOs. And there was a big IPO boom and a lot of interest coming into the primary market. On the other hand, in the physical assets, you know, there was not so much of excitement. And 91% of physical assets are in gold and real estate, and gold has not really moved. Post RERA, a lot of people actually were very negative on real estate, and real estate has only moved up by 8%. Compare that with equity, which has moved up 23%, mutual funds have moved by 39%.
And let me just clarify for viewers' benefits, when we're talking about these percentages, this is not the appreciation in the asset class value.
No.
This is the quantum of money that's gone in as an investment in these asset classes. And the appreciation, both put together. So that's how the percentage changes are coming. So just to quickly run through some of the initial numbers, the total wealth held by individuals in the country in assets went up by about 11%. Individual wealth in financial assets was up by 15%, whereas in physical assets, that number was just up by 6%. So it's been a great year for financial assets. Let me actually start with that and get, you know, into slightly more granular detail. Mutual funds as a category, 40% growth. I mean, the money managers would be really smiling when they look back at the year, right?
So, no, I actually have seen mutual funds from 1996 when I used to work for a mutual fund. And at that time, we had to literally go and sell mutual funds outside. Today, people are coming in buying mutual funds. So, there are two reasons for the growth. One reason is obviously demonetization, where people saw money going into the banks. People saw the money was lying idle, and they said, let's move that to something else, like giving us slightly more returns. The second reason is the global boom on the equity markets, because of which people have actually seen serious wealth creation. And what we have seen is we have seen investors moving from wealth preservation to actually capital appreciation.
Because people have really understood that fixed deposits, for instance, and that was another interesting number, fixed deposits and bonds, the growth is 9% for 2017. How does it compare to previous years?
So previous years, in the last year, equity had gone down. So FDs was at the top. But if you see the numbers carefully, equity is nearly there. It is just number two. It's 37 lakh crores and FDs are 40 lakh crores. So what we believe is that this race is going to be a one-horse race in the years to come. In the next 5 years, we'll see equity really raging past like a bull beyond fixed deposits.
Okay, fine. We're going to talk about, of course, those equity trends and what lies ahead in 2018 in just a bit. Let me get your thoughts on insurance. The total growth here that I see is about 17-18%. what particularly is growing? Because I'll tell you this, I mean, on Money, Money, Money itself, now we see a lot of the independent advisors come and really talk about the importance of term insurance.
Yes.
And delinking, maybe simplifying the structure, keeping your sort of investments in one pool via mutual funds, etc., and keeping your insurance needs very, very carefully sort of segregated. So what is growing in insurance? What products are doing well? What do the studies say?
So see, we have been doing this report for the last 8 years, and insurance has always been in the top 4. Now, a lot of money is moving into insurance, and we believe that it will keep on going up because India, at the end of it, is a very, very underinsured country.
Oh, absolutely.
So the growth is just going to skyrocket, and we expect insurance to remain at the top. We also advise investors to segregate insurance and investments, but the basic need of life insurance is something that is that has a long way to go.
Let's move to the next. Of course, you know, cash is down 20%, and we know why. So that's a pretty self-explanatory sort of you know, part. Pension funds. 21% growth in pension funds. So what specifically have you included when you say pension funds are growing by 21%?
So pension funds, the majority growth has come from the National Pension Scheme, which has seen a huge growth because there's an additional 50,000 tax saving.
Yeah.
And I think it is a really good investment for anybody who has finished the tax saving limit. Not only would he get a return straight of 33% if he's there in the top tax bracket, because he's saving that tax at the inflow of 50,000.
50,000, yeah.
But the returns also will be commensurate because it is based on the age profile of entry, and a part goes into equity, a part goes into debt. And I would recommend every investor to take NPS as an additional tax saving.
At least that 50,000. Yeah, because again.
So I have opened an NPS account and I'm very happy about it.
Okay, brilliant. All right. Then let's talk about what the super rich have been up to. Because we've just discussed a lot of the asset classes that, you know, I would invest in, our viewers would invest in. But then for the HNIs, I mean, whether it's alternate investment funds and exotic investment, what trends have come up?
You know, I just use some Hindi, but you know, there's this terms called Sasta, Kifayati, Asardar. And that is what mutual fund is. Okay, mutual fund remains the core for a retail investor. Mutual fund remains the core even for a HNI. Because that is where you get a transparent instrument giving you maximum possible risk-adjusted return and high liquidity.
Sure.
Now, if you come to HNIs, what they do is they go beyond mutual funds, and if you're looking at the equity allocation, a lot of HNIs have invested in equity PMS, portfolio management services. You know, why do you buy a mutual fund? You say don't keep all eggs in one basket. In a PMS, you keep all your eggs in a few baskets and watch the baskets carefully.
And hopefully those baskets will have a couple of those golden eggs that kind of really make your portfolio look fantastic. So, okay.
Absolutely.
So PMS has done well this year, is it?
Yes, it's done well. A lot of people have also invested on the HNI side in private equity funds.
Okay.
And we will only recommend those funds for people who have portfolios of 4 to 5 crores.
Okay.
Because it's a pure ultra HNI product. We have also seen HNIs doing a lot of innovative investments in real estate.
Okay.
Which is something new. So whether it comes to student housing or warehousing, we have even affordable housing. We have seen HNIs going back to real estate slowly but surely.
Okay, real estate. Yes. I want to, in fact, spend some time on real estate. We'll do that in the next segment. But before that, let's actually quickly cover the rest of the physical assets as well.
Yes.
Gold up only about 4%. Is that because largely the asset class hasn't done much? I mean, it's been a very
as you said,
year.
Cash is no longer the king. Now, gold and real estate, if you look at the entire history of 100 years or 200 years of investments, people have invested their entire investment and savings into gold and real estate. But as we are going ahead, people are seeing that the returns are not there. And we are seeing lesser of incremental investment going into gold. So gold also will no longer remain the king for a long time. Real estate, so gold last year has only gone up by 3%, and real estate has gone up by 8%. Going ahead, what we recommend to our investors is that gold is purely a hedge in your portfolio. It should not be more than 10% of your investment, and the preferable form would be a ETF.
Okay.
On real estate, we believe that the cycle is turning.
Mr. Bhave, let's talk about the future, 2018. All said and done, at least calendar year 2017 was phenomenal for the equity market. I mean, 27, 28%, uniform one-way journey. I don't know, is it going to be as good this year? That's what everyone's thinking.
So Newton's law says whatever goes up comes down. So you're right. But I think it's important to take a view of 3 to 5 years. And you know, just like a lot of people who come on your show, I think I'm extremely excited in terms of the wealth creation prospect for the next 5 years. If you look at the year 2018, we are overweight on equity. And we still believe that whatever one might talk of valuations, it is a good place to be in. Because, you know, stock price is a slave of the profit after tax of a company. And profits go up if revenues go up. And with the entire consumption in the economy, with a lot of global giants now coming back and doing well, we believe that the top line and the bottom line is only going to go up. And we believe that equity through mutual funds is a great place to be in the year in the next financial year, next calendar year.
Okay. Now, within funds, I know it's tough to generalize because you know, it will be different for different risk profiles and risk appetites. But within mutual funds as a category, are there certain types of funds that you're more bullish on for 2018? Maybe a certain type of hybrid fund, or you know, something that stands out as a product? So
which companies do well? The companies that do well are the companies which have a strong management, better corporate governance, and a good business model, where the risk of not doing well is low. Those are large caps. So obviously, if you follow hub and spoke model, the majority investment should be in large cap companies, where there's a higher probability of returns coming in. But because you want the alpha in the portfolio, you also go into say 20% of mid cap and small cap, and maybe 10% of sectoral.
Okay, fair enough. So let me actually, on that note, talk about the other asset class. Yes. Equity, as you were saying, you're already overweight and it should do well. What about debt? Because this has been a year when, you know, interest rates sort of, the feeling is that maybe we won't get any more cuts. Who knows, maybe the RBI starts getting hawkish. Bond yields have been rising last couple of weeks. What does it look like, at least the first couple of months of 2018, for fixed income as an asset class? And if I want better returns than an FD, then what should I do? So
debt is a very, very non-glamorous asset class. Yeah. People don't like talking about debt. But if you look at our India Wealth Report, in India and globally, 40% of entire investment is in debt. Now, traditionally one looks at fixed deposit, but as you rightly said, it doesn't make sense because obviously you have to pay a lot of tax.
Yes.
The idea is that some part of the portfolio you're not taking risk. And if you're not taking risk, one should not be greedy. And if one is okay with a return of 7-8% on that part of the portfolio when one wants capital preservation, then a debt fund with a 3-year horizon makes a lot of sense.
Okay.
And you know, you can have different styles of debt funds, but just for getting that 1-2% extra return, a lot of investors do not want to take that extra risk.
Yeah.
So for an investor, I think it's important to look at debt for capital preservation. Not just mutual funds, debt funds also look at tax-free bonds. And if one still wants a slightly higher rate of return, one can look at corporate debt, which is giving you a slightly higher return.
It is, but that's the really important point that you raised, and something that I personally believe in very strongly, that if you want to be a maverick and if you want to chase returns, then just move to equity.
Absolutely.
You know, the idea, the concept, the whole sort of fundamental reason why debt should be in our portfolio is very different. But having said that, how do you view the corporate bond funds right now? SEBI wants them to be called, I think, corporate risk funds, not corporate opportunity funds anymore. But just your view and sort of the caveats that go with these funds?
So in the space that we operate in, we actually recommend more of secondary market tax-free bonds, because then there is zero default risk, and you are just playing on the yield and the capital appreciation. Okay. But when you're looking at these funds, as I just said, there is always this risk of the movements up and down.
Okay, fair enough. That brings us to the asset class that you're actually bullish on, and that's real estate. Last year, we saw it appreciate by 8%, as in the quantum of inflow and the appreciation. What makes you optimistic on real estate in 2018?
See, one thing you have to remember, so many rich people that are there in the world today are rich because of real estate. And that has given them a lot of upside. You know, real estate has been down and out for some time, but a lot of things have changed. And one major change is RERA. And second major important reason is the interest rate on housing loans. You know, it has come down.
8.3, I think it starts now, or 8.6. Yeah.
It will come down further. I have seen interest rates of 6.75%.
Okay.
And that is when actually people who have been postponing purchase of the dream house would want to still leverage on their earning capacity for the next 10 years, 15 years.
But the end prices still haven't moved down significantly, barring maybe very highly oversupplied markets like NCR or thereabouts.
Yeah, so if you want to buy a property in Bombay, you will think twice and thrice and 4 times. But a lot of people are actually investing into affordable housing.
Okay.
And they are saying that this is where I want to stay once I am out of this rat race. And we are seeing a lot of interest in those kind of investments. Okay. And there's also in fact, there's something a lot of people should know. There's something called subvention, which really helps investors make a much higher return.
Yes.
So you take a housing loan, which the developer repays for 3 years. And so there's a property is worth, say, 1 crore. You only put 20 lakhs now. And you start repaying the loan after 3 years. And after 3 years, if the property is worth 1.2 crores, your return is 20 lakhs on 20 lakhs. So that is something a lot of smart investors are using in.
Okay.
But to summarize, we believe that the industry will actually have an upturn cyclically. RERA will help, and lower interest rates on home loans will help.
And what sort of a return are you expecting from the asset class, or whether you're talking about rental yields or just the sort of price appreciation? Are you expecting price appreciation in 2018?
Yes.
Capital appreciation?
Rental yields have actually have gone down to the bottom, and they can only go up from here. In terms of appreciation, it may not happen in the next calendar year. If one is going to invest in real estate, one will have to wait for 4 to 5 years.
Okay.
So I think it's a good time to start looking for the property. You can take your time, but I think over the next 6 months to 9 months, one can take that call.
Now we've discussed what worked in 2017. We've discussed, regular asset classes like debt and equity. Do you have any bitcoins? First is my question. Then we just look at you in awe.
How I wish. How I wish.
Well, what is going on? I mean, it's defied logic completely.
So, it's very interesting. Exactly 1 year back, we had last year's India Wealth report from Karvy Private Wealth, and we had covered cryptocurrencies and Bitcoin.
Okay.
And at that point of time, the Bitcoin was less than $1,000.
$1,000?
Less than $1,000.
Less than $1,000.
So it has gone up 16 times.
Yeah.
But we at that time also we are cautious, and even today we are cautious.
So people read the report very carefully. I don't know what you've covered this time around, but I'm going to look through the fine print. Yes, please carry on.
But Reserve Bank of India has also come down with a negative view. See, the problem with Bitcoin is that there is no regulation. There is a buyer and a seller who don't know each other, and there is no intermediary. And it is being used, a lot of people say, for money laundering, which is not something that global governments are going to look up to. So it is not something that we would recommend. It is a fad, and it is something that has caught the fancy now, and everybody's talking Bitcoins. But for an investor, if you ask my recommendation, I will still say no.
Okay. So then final thoughts as we are looking out for 2018 now. Anything that stands out, any one trend or any one big expectation that you'll have on the wealth management side, even from the industry's perspective, client engagement, the way products are going to be delivered, sort of anything that comes to mind immediately?
So what is important is what is good for the customer. If you just overturn everything and see from what the customer wants, the customer wants returns, the customer wants ease, and the customer wants transparency. So I think it's important that they ask the wealth manager, investor, he should ask the wealth manager, please tell me what are the risks involved in this investment. Please tell me what is the kind of return I would expect, and I would not really want to go beyond that. In terms of trends and in terms of new trends, as I said, it's more of equity and real estate. But there are two things that we believe will do really well, are doing well this year. One is in the HNI space, the alternative investment funds, AIFs. And there's been a lot of interest on private equity funds in the unlisted space.
Right.
And we see a lot of money moving there.
Okay.
Secondly, because there has been a lot of IPO success, we are seeing increased investor interest in unlisted shares.
Pre-IPO?
Pre-IPO.
Okay.
Where people have seen DMart and people have seen Apex Foods, and people want to find the next DMart.
Yes.
So there's a lot of interest, but that's where we want people to have a bit of caution.
But does that worry you exactly? Because the manner in which IPO mania swept the street, pretty much like the way the market has been moving up. But are some of these, and these are of course all off-market transactions because they're happening pre-listing, Are they happening at realistic, reasonable prices, looking at company fundamentals? Or again, has it become a bit Bitcoinish even in that market?
So let's look at the macro thing. You know, with Make in India and Skill India, a lot of SMEs are coming into growth mode, and they will want to unlock value, and they would want to list in the next few years. So if you actually partner with the right company, you can make that money.
Sure.
And you go through a private equity vehicle.
Okay. But not for the faint-hearted, and maybe not for the pure retail investors who don't have too much.
And the returns won't be Bitcoinish.
Okay, fair enough. Very interesting insights. Thank you so much for joining us on the show today. We wish you a great end to calendar year 2017 and a fantastic 2018 as well.
Thank you so much, and same to you.